Good morning, everyone. My name is Michael Naidrich, and I am the co-CEO of Amerivet Securities. As always, I am joined by my partner, CFA, all things rates, liquidity, Fed, Gregory Faranello. Hey, Greg, how you doing, buddy?
Good, Michael. How are you?
Good.
Good
So,
morning.
we were talking earlier in the week, and there were obviously big speech this morning by Chairman Powell out of Jackson Hole. A lot going on just in general with the conventions and politics and rates and everything. So I thought, hey, let's have a little chat here going into Labor Day weekend and give our clients some of our thoughts, which is really your thoughts on Powell's speech and some of the key themes and the market reactions and whatnot. So maybe we start there and then we can continue moving forward after that.
No, that sounds great. And it was a great idea. I mean, I know we've done these a couple of times over the last 5 years. This year, obviously, with the Fed in play, I think Jackson Hole was sort of front and center leading up to it. Look, I thought it was a great speech. I thought the chairman gave a great speech. Largely expected that he was going to say they're getting ready to lowering interest rates. The good ship transitory. He threw some levity and humor in there as well. But a couple of quick points. They don't seek or welcome further downside to the labor market. I thought that was key. Inflation expectations, he talked about that as well, which was also key. And then he ended by saying, the limits of our knowledge in terms of policy and humility. And he talked a lot about the pandemic, which, as we've written extensively about over the last 3 to 4 years, working through some of those dynamics and policy. So, quickly, I mean, they don't seek further downside with employment. The unemployment rate has moved up quite a bit. And I think at the beginning of this year, the rate market at least, was following the establishment survey with the headline numbers. We got these big revisions this week, which, we've been writing to clients about negative 818,000, which was big. And the unemployment rate has been ticking up. So they're clearly, the balance of risks here, they're clearly focused on protecting any further downside in the employment market. That was key. Inflation expectations. Look, if you look at market-based, and they come in various forms, consumer, business, survey, market-based. If you look at market-based inflation expectations via the TIPS market and the Treasury market, out through 10, 30 years, I mean, we're in and around 2%. So the Fed has done a very good job of keeping inflation expectations anchored around that 2% level. And I think he was explicit about that, and they deserve a lot of credit for that. And then limits of knowledge in this market. Look, we just don't know, right? To your point to start, the fiscal side of the equation has been, I think, a headwind to their policy vis-a-vis big deficits. And we have this election, and we just don't know how it's going to go and what the spending picture is going to look like going forward.
Yeah, thanks, Greg. I'd like to take a couple of minutes here if we can. And there's been some big swings in rates in 2024. Fed pricing, long end yields, yield curve, etc. What do you see as most important ahead here post Labor Day?
So I still think it's largely about employment and inflation. Inflation has come down. I think if you look at late 2023, when Powell first started talking about rate cuts, we had this huge duration grab. Everything came down by a large amount. And then we spent the first quarter repricing that a little bit, consolidating over higher inflation prints and stronger growth, and the market following these establishment employment numbers. From May on, we've come down, and I think we've had a pretty good call here in 2-year yields and 10-year yields. We've come down 100 basis points in each bucket since May over, lower growth, tempering growth, lower inflation, and now the plausibility of actually getting the rate cuts. So, the direction of traffic, to me, to use Powell's words today, we still like the lower rate story. We wouldn't say it's a duration grab at this point, probably more of a grind, but there's room below for sure. I mean, we've got 50 to 75 basis points, we think, of room below in rates, but we do favor the curve to continue to try and steepen out here. In 2s to 10s, there's negative carry factors, but we do see that curve going positive in the months ahead.
I appreciate that. So let's do a little more interactionary stuff here. As I always like to, rightfully so let you take the lead on a lot of what we discuss here. But one of the things I appreciate, and I actually appreciate Chairman Powell's self deprecation a little bit on transitory today, right? But I also think he's done a really good job in the last year plus on transparency. And he really has let the market do a lot of the work for him with his transparency. And, I try to look at, what our clients are thinking and what they're saying, and overall business, you know, um, conditions in general. I think, quite honestly, I think we're going to get seasonally slow here for the next couple of weeks. Maybe, leading into Labor Day. I think it's been a very busy year in the debt capital markets. The equity capital markets has bounced back somewhat, not as aggressively as I think people thought with the pipeline and some of the IPOs that came out. But one thing I keep thinking about is I think we're in for a massive September in issuance, because I think you're going to get the 2 week slowdown seasonal. And then you're going to have sort of the unknown of the election. And we'll get there a little bit, I think, in our last segment. But I think people are here in this September to like mid-October as we try to figure out this election and where it's headed. I think you're going to see a very busy issuance season. How do you feel about that?
Yeah, I mean, I like that theme a lot. It's been an uneven year. As you're saying on the DCM side, it's certainly been steady and opportunistic. I think the issuers are very in tune with the calendar and the economic releases. But I think today is a big day for markets. I mean, equities are certainly enjoying it. I think the Fed chair is saying, the floodgates are not open, clearly. We still favor they come down gradually and slowly, but the path of traffic here seems pretty clear. We had this yen carry trade debacle a couple of weeks ago. Markets have recovered nicely. So I like the lower rate story. I like it. I like what I heard from Powell today in terms of getting in front of this a little bit. And I think it's going to be a great environment for issuers. We don't know how the election is going to turn out, but yeah, to your point, and I agree, this window, September, October, before the election, I think is going to be really, really big and fun.
Yeah, yeah, I agree. So I think I got two more topics as we head into ending our time here. You know me, I'm extremely politically independent, and that makes this easier for me to discuss. But we do have a big election, and it is going to be a contentious election, and it's by all, you know, polls and predictor things, it's going to be very, very close. And just talk about the impact of the election. You and I are never going to get political, especially in a forum like this, but it is a reality. It is something we need to acknowledge, and I'd love to hear your thoughts about this.
So I look at it through it's not political to me. I always look through things from a policy prism.
Mm-hmm.
And when I look at both sides of the equation, and look, there are some people out there that may disagree depending on what side of the aisle you fall on. I still see us in a pocket of spending, right? Regardless of who wins the election, we can kick around the policies, but back in the day, Mike, right? We had the Tea Party movement, right, where people were, we had fiscal hawks out there. I mean, we're growing our deficits now between 1.5 and 2 trillion. And there's nothing really that I'm seeing in terms of policy that's going to thwart that trajectory. So my concern is, and I think it should be the Fed's concern as well. They will not say it as explicitly as this, but regardless of who wins in November, I think the spending is going to continue. It may continue in different forms, and we don't know where that money is going to get allocated to. But it's a consideration, because I do think it's been a big headwind for the Fed. I do think they will start to come down. But if I'm Chair Powell right now, I'm going to be a little cautious that maybe some of the humility that he mentioned toward the end of his speech today. But we're going to be spending money going forward. There's no question about it, and that's going to have an impact on the economy, and it could have an impact on inflation too.
Yeah, that's a really good point, and I really appreciate your keeping it to the policy, and obviously always recognizing that's the most important thing. All right, so the last thing, so Mercedes doesn't get mad at us for going over our time, and having a post cap lesson on keeping to the efficiency of the time frame here, is I'm going to put you on the spot here, bud. I think everyone is saying we're going down, and I think that's real. So give me what it looks like. Is it 25 in September and maybe 50 later in the year? Is it where are we headed here? Give me the Greg Faranello CFA roadmap to the end of the year for our clients.
Well, the forward curve is already priced at 3%. So if you look
Right.
at SOFR 2025, 2026, that terminal rate is already at 3%. So if you view neutral like I do as a little bit higher than where the Fed has it right now at sort of 2.8, and you don't believe we're going back to the zero lower bound because something big is not going to blow up or happen, we're already kind of priced there on forward space. On spot space, I think we can come down more on treasury yields. Look, I think the Fed is in 25 camp right here. I mean, that's my gut reaction. We'll get an employment number the beginning of September. As you pointed out, I think it's going to be busy. Markets are going to be focused on that number. We could skew pricing, but I think the Fed they want to come down gradually. I think they will come down gradually. So I believe in 25 basis point increments here going forward. They could get a couple of rate cuts in 2024, and then we'll see how the economy evolves post 2025. But like I said, if I'm Chair Powell, I'm going to take it a little easy here. We set the course of action. The market is doing a lot of the Fed's work. I want to see the outcome of this election. So I favor 25 in September and 25 increments thereof in 2024.
Yeah, and I'll tell you, I think he deserves a lot of credit for not panicking with the disruption in the market a couple of weeks ago and doing a mid-cycle cut. I give him a lot of credit for that, and I think that long-term stabilizes markets versus looking like short-term panic. So good for him on that and his crew. Well, Gregory, it's been a heck of a 9 months or 8 months, and I know you're going to try to get a little R&R here in the next week or so. But I will tell you that if our clients want you, I know you'll be there for them. So try to get some rest, have some nice walks on the beach and whatnot. Enjoy your family time. I know the clients appreciate it. You know, I certainly appreciate it and love doing this with you. So clients, if you need us, we're here. We are always here. And Gregory, thanks again, bud. And I wish you a nice long weekend, bud.
Thank you, Michael.